Hi, Neil here. Welcome back. We're looking at part 2, inventory related fraud, chapter 12. And again, I want to start with this top 25. And it kind of worries me that I haven't listed many frauds here that look at the overstatement of inventory. There may be one or two that could belong to this group. But remember, these frauds here are multi-billion-dollar frauds. The examples I'm going to give in this second part are not as large, except for probably the Farmore fraud, which should be part of this group. But for now, the Valiant Pharmaceuticals fraud was a big one with the overstatement of inventory. So was the Sunbeam fraud that involved the overstatement of inventory as well. So let's get back into this part, shall we? So here we are. Inventory and cost of goods sold frauds. Besides revenue-related fraud schemes, the next most common financial statement fraud schemes involve the manipulation of inventory and cost of goods sold. So when the book says the next most common, and you go back to the table I showed you, how come there was only 2 of the top 25? They were the 25 big ones, the multi-billion-dollar frauds. But if we look at the most common, under 1 billion, this statement is correct. And let me explain to you shortly where I show you a table of smaller inventory-related frauds. But before we do that, in this part of the chapter, let's have a look at 2 examples that are in the textbook. The 2 examples was Farmore and the Rite Aid Corporation. Now, Farmore, that was just plain and simple overstating inventory value. They moved inventory and they just counted it multiple times, and that ended up being over a $1 billion in fraud. The Rite Aid Corporation was much more elaborate. They had fraud schemes where they overstated net income, they managed inventory value, but also senior management, they failed to record shrinkage due to the loss or theft of inventory. By the way, shrinkage is a catch-all phrase for in any inventory loss in a retail establishment, okay? And that loss could be because of weather damage, falling off the back of a truck, actual employee pilferage, or customer stealing, anything where inventory gets lost. For any of those reasons, fraudulent, non-fraudulent, we call that shrinkage. So senior management failed to record shrinkage. And when you fail to record that, that means your inventory goes up, your cost of goods sold go down, therefore your gross profit goes up, and your company's financial performance looks even better. Wow. All right. Now, Rite Aid Corporation, they also, as I said, they engaged in topside journal entries, okay? Credit sales, debit accounts receivable, all right? Just creating those journal entries out of nowhere, all right? And they lowered the cost of goods sold. As I said, if you can increase the ending inventory, that lowers your cost of goods sold, that lower value gets deducted off your sales revenue, and therefore your gross profit is going to be higher. Operating expenses the same, then your net profit is going to be higher. Wow, quite easily done, isn't it? All right. So as I said, we could have a look at another example in chapter 12. And without going through this elaborate fraud that Miniscribe went through, let me just point out a few ideas. Number one, it was basically an excessive inventory overstatement, like $22 million of overstatement. But by the 3rd year, it went up to $31 million in overstatement. And you're probably wondering, Neil, so what's the point here? Oh, once you start playing with manipulating ending inventory, like making it higher so cost of goods sold go down, so gross profit goes up, then in the next year, that higher ending inventory becomes a higher opening inventory. And so at the end of that 2nd year, you have to manipulate the ending inventory again in order to preserve the exact same cost of goods sold or make it even larger to make cost of goods sold even lower. All right. So this is different from just crediting sales and creating accounts receivable. Now you're playing with physical objects in the organization, that is inventory. And so if you change the value of inventory one period, that value goes into the next period. And it goes at the top of the cost of goods sold. Now, if you don't fraudulently adjust the ending inventory in that second year, then your cost of goods sold in the second year is going to be very, very overexposed, all right, over exaggerated, where it was under exaggerated in the previous year. So that's why they went from a 4.5 million overstatement to a 22 million overstatement, then to a 31 million overstatement. Wow, the things that senior management do to preserve the fraud. Okay, this is amazing. All right, so what do you learn from this? If you want to undertake fraud, just stick to sales, revenue, and accounts receivable. Don't get involved in inventory. All right, so the fraud detection, how was it detected? Well, in the first year, it's difficult to detect because there's minimal accounting symptoms. But when you go into the second year, there are more symptoms and there might be tips. There might be more suspicious end-of-year transactions. When it goes into a third year, even more so. And it's likely that because they could make an inventory bigger and bigger and bigger and bigger. And in one case in chapter 12, if you extrapolate the value of inventory that they said they have and thinking, okay, how big must the warehouse be to house the inventory? The warehouse had to be more than double the size of the actual warehouse that the company had. Or in another example, if the inventory items are so large or so heavy as you are saying they are with respect to their value, then where's the crane or the forklift that has that power to lift such inventory? And they didn't have such powerful forklifts in their warehouses. So the problem with fraudulent inventory misstatements, overstatements, is that there's a physical twin that you have to think about. And so that makes it a little bit more problematic than a revenue fraud. Here are the 14 largest inventory frauds. And remember, as we're going through here, remember, my job is not to pick out every list of things that you have to do in chapter 12, but my job is to try and make this interesting to you by showing real life case examples. And as you can see, I should add far more. I should add far more to the top 25 because 1.1 billion, it belongs there. And health management, I think health management's in there, and Satyam, that is in there, and one or two others could be in there. Toshiba, that could be in there too. So there's a couple that will bring it up to the top 30 of frauds that are over $1 billion. And maybe I need 2 PowerPoint slides to house that. But just keep in mind, these things are growing as we get more information. But why do I want to show you this? I want to show what the symptom of the fraud is, because the symptoms is how we're going to find out the fraud. In this case, a lot of these frauds came exposed due to the analytical anomaly 1, 2, 3, 4, 5, and a few others. As you can see, nearly half of these were analytical anomalies. And again, there was an anonymous tip in 1, 2, 3, and 4. Again, 4 anonymous tips. So tips and complaints are very, very important in revealing these frauds. And the duration, here's the other thing. Unlike other type of frauds, these inventory frauds end up going for 2 years or more. It's very hard to start and stop an inventory fraud in one accounting period. And then there's all the different types of inventories that were exposed. So you can look at and learn a lot of interesting patterns from this data. And another way is to graph. If I look at the type of inventory-related frauds, consumer and retail products, electronics, medical supplies were the big ones. If we look at how the inventory-related frauds were uncovered, SEC investigation, anonymous tip, internal audit, and whistleblower complaints. So, tips and complaints making up more than 50% of inventory-related frauds. If we look at the frauds by symptoms, you can see across those 6 symptoms, the analytical anomaly or accounting discrepancy and documentation are driving the symptoms of the fraud, less so the extravagant lifestyle, less so the unusual behavior of the fraudster. As I said, lifestyle and unusual behavior of the fraudsters, they're not going to be the big symptoms that are going to show up in Chapter 12 and Chapter 13. We're looking at financial statement frauds here, earnings management. If we look at the effects of inventory overstatement on income statement, as I said, what happens is the cost of goods sold gets understated, the gross margin is overstated, and the net income gets overstated. You want to overstate income to meet earnings expectations, to power up the stock price, so you get a big bonus. If you're the CEO, you're the CFO, you're a C-suite manager. And you're in cahoots with other C-suite managers. All right. Yes. And the effect of cost of goods sold on inventory, again, when you study management accounting, you know that there's a beginning inventory, there's the purchases, there's the returns of inventory to the vendor, purchase discounts, goods available for sale, ending inventory, then cost of goods sold. In the end, we want in period 1, we're going to understate cost of goods sold. But if we don't do anything in period 2, what's going to happen? It's going to become overstated. It's going to balance out the other way, because what you have overstated in ending inventory here becomes overstated in beginning inventory in the next period. And so then if you don't overstate ending inventory again in the second period, just like in the mini scribe case, they needed to overstate again to keep the fraud ongoing. If you don't do that, then your income comes back to zero because suddenly your cost of goods sold has gone up ginormously. You've just basically brought forward revenue from a future period into the current period. Wow. Common inventory-related fraud schemes: overstating inventory, double counting, cut-off problems, capitalizing costs that should be expensed. So overstating inventory are the common ways of fraudulently dealing with inventory. Yes. Again, we had a transaction sequence for revenue. Well, with inventory, the transaction sequence is we purchase it, then we may return some goods, we may take a discount, then we have to pay the vendor, then we sell the inventory. Is there any inventory obsolete? Then we write it down. Can inventory be counted? Then we estimate quantities, then we count it, we determine inventory costs. So it's possible to manipulate any one of these areas to try and overstate inventory. Rather than going through every detail of these transactions, I just want to show you, if you look at the 14 frauds in the table I showed you earlier, 9 of them, inventory quantities were estimated, and 4 of them, inventory quantities were counted. You notice that's 2 of those areas that were noted in the textbook. So what I'm doing is showing you where the patterns in the data lie and relating it back to this table list in Chapter 12. So don't take every one of these transactions as equally opportune for you to commit fraud on the inventory. The data shows us that maybe these 2 areas are ripe for the picking if we have to overstate inventory. Okay. Identifying inventory-related fraud symptoms. Analytically, as I showed you in that top 14, there was analytically anomalies, accounting discrepancies, and documentation. They dominated the symptoms of inventory overstatement. If we look at the control symptoms, they were next. internal control weaknesses, let them happen. Behavioral and verbal symptoms, they came much less, only occurring in 1 or 2 instances out of the 14. And finally, lifestyle symptoms really didn't show up on the radar. What did show up was tips and complaints, SEC investigations, anonymous tip, internal audit or whistleblower complaints. Again, remember what I said in earlier chapters, tips and complaints, they're symptoms and not evidence of fraud on their own. And the reason is those tips or complaints can have or be self-motivated and nothing to do with the actual fraud. There may not be an actual fraud at all, and someone is reporting a tip or a complaint to get back at you because they don't like you. All right. Having said that, tips and complaints, again, are a welcome resource, and it's something the fraud investigator needs to pay a lot of attention to, especially when they are walking around the organization trying to befriend people in the organization and not being a detective, but being more of someone who wants to understand how the business is going, what are the challenges it is facing, and how employees are coping, etc. Someone for employees to talk to because maybe they feel senior management is not listening to them. So if you come on board on the premises and say, I'm the detective, they're not going to talk to you. A way of getting tips and complaints is to try and become a friend, try and show empathy and to learn how the organization is operating, who is in charge, who is talking to who, what does the behavior look like? Again, that's what this means for you as a fraud investigator. When we are proactively looking for inventory-related fraud symptoms, we really want to look at analytical symptoms. And one way of doing that is as follows. We can analyze the financial balances and relationships within financial statements. As I said earlier, horizontal analysis or vertical analysis. Horizontal meaning trends over time. Vertical, looking at relationships between items in the cost of goods sold, with sales, with gross profit, with net profit. All right. And looking at those relationships over time as well. Or we could compare financial statement amounts or relationships with other information. As I showed you, I gave you non-financial information in a slide, several slides back, about the size of the company, how many stores they opened, how many square feet of floor space, how many employees they had. All right. How strong are the cranes and the forklifts? Anything like that where you can relate numbers to over time can reveal many things about inventory fraud. Again, finally, as I asked in the first part, we can ask the 5 whys, and this is where we might talk to the accountant and we ask more of these penetrating questions about the last week of the accounting period or the beginning week of the new accounting period, because that is where manipulations are more likely to take place, especially with ending and beginning inventory. Actively searching for inventory-related control symptoms. Again, we can look at internal control, whether proper documentation and authorizations are undertaken for the physical movement of inventory, etc. We want to see that transactions match the physical movement of inventory. And are the transaction accounts accurate, properly classified, recorded in proper periods, included in proper financial statement accounts? So again, we're after documentary evidence to support the accounting entries, but also we want to look at documentary evidence of inventory that we see in the warehouse. Actively searching for behavioral, verbal, and lifestyle symptoms. Again, You can look for that. Again, here's the opportunity to befriend employees, people in the organization. Perhaps you can understand and find strange behavior, but equally likely, you might become a shoulder to which someone shares a tip or a complaint that turns out to be the real deal. Final on these slides, we want to come back to the big financial accounting frauds. What we did in this part is show you that, yes, overstatement of inventory is something that is prevalent, maybe not prevalent in the multi-billion-dollar frauds that are listed here, but as the book says, they are the second most common. So once we go below 1 billion, once we go below 100 million, you might find inventory overstatement as a very common fraud, second to revenue fraud. As I said, the big learning takeaways I want you to think about is not to think as an auditor, but to think as a fraud investigator. What do you learn by picking out some of these companies and learning how they executed and got away with and finally were caught? What do you learn as a fraud investigator? And I think this is the best way to make Chapter 12 and Chapter 13 exciting for your learning objectives in this unit. This is the end of part 2. See you in the next section. Bye for now.